Although the total value of the cryptocurrency market plunged by nearly $1.4 trillion in 2022, many investors could have benefited from the downturn through tax loss harvesting, a practice that can be useful to those who have assets that declined in value. It's too late to take advantage of the 2022 tax year, but this can be the right time to start preparing for 2023. Today, we're going to be showing you the ultimate guide to prepare for the 2023 tax loss harvesting. Let's get into it. Crypto tax loss harvesting is a strategy used by crypto investors to reduce the amount of taxes they pay on their crypto investments. It involves selling crypto assets at a loss in order to offset any capital gains that have been generated from other investments. This strategy is used by investors to minimize their tax burden and maximize their profits. To understand tax loss harvesting perfectly, you must first understand how the Internal Revenue Service handles cryptocurrency earnings and losses in order to comprehend tax loss harvesting. Virtual currency is considered property by the IRS, so when you sell at a loss, the agency permits you to use these losses to offset capital gains from other assets. If capital losses exceed annual capital gains, investors can use the remainder to offset up to $3,000 from their regular income at tax time. Capital gains are generally taxed at a lower rate than ordinary income, which includes earnings from a job or a side hustle. Keep in mind that capital gains can only be offset by the same type of loss. Long-term gains, which means you've held your crypto for longer than a year before selling, can only be reduced by long-term losses, and short-term gains, which means you've sold your crypto before 1 year, are reduced by short-term losses. So, with tax harvesting, crypto investors can use these rules to their advantage in a way that other investors can't. What makes crypto different? Simple. Unlike stocks, the wash sale rule doesn't currently apply to crypto. Unlike stocks, according to the IRS, if you sell a security at a loss, then replace it with the same or a security that is substantially identical within 30 days of the transaction, you are not eligible to claim a tax deduction. This means that, in principle, you could sell your cryptocurrency, report a loss, and then buy it again right away, without having to wait the customary 30-day. However, Shehan Chandrasekera, a certified public accountant and the head of tax strategy at the cryptocurrency tax software startup CoinTracker.io, warns against abusing the tax system by using this loophole. According to her, the IRS will disallow the tax benefit if you're frequently selling crypto at a loss, then immediately buying the same digital coin. He said, "I would not advise anybody to do that. I would say just wait a reasonable period of time," he says. Obviously, you don't have to wait for the 30 days, but again, wait a reasonable time before you buy back the same coin. You can choose to do this once every quarter or even once every month to be safe. If you want to move forward with harvesting your crypto losses, it's important to understand how it could impact your tax bill. The profit from the sale of appreciated cryptocurrency that you've held for more than a year will be taxed as capital gains. Despite the fact that capital gains are taxed at a lower rate than ordinary income, it is still preferable to offset those profits with capital losses, because doing so can result in a reduction or even a cancellation of the tax you have to pay. Besides the obvious benefit of paying less capital gains tax, tax loss harvesting crypto comes with a few other perks. In some countries, you can offset your capital losses against your income in addition to offsetting them against capital gains. For instance, in the US, you are allowed to offset up to $3,000 in annual capital losses against regular income to lower your total tax burden. For example, if you buy crypto for $10,000 and sell it for $13,000 later, you would have to pay $3,000 in capital gains taxes. However, you would be eligible to offset the tax you owe if your crypto trades resulted in losses of $3,000 or more. Furthermore, if you have $10,000 in capital losses but only $3,000 in capital gains in a given year, you can carry the remaining $7,000 over and use it to reduce future capital gains. If all you have are losses, you can carry them forward to offset against gains in future financial years, helping you pay less tax in the future. It is important to keep in mind that cryptocurrency tax loss harvesting requires meticulous recording of your purchase and sale prices. This can be difficult for some investors without the use of reputable software that can track your transactions for tax reporting purposes. Also, it is important to be aware of the risks associated with this strategy. If an investor is not careful, they could be subject to capital gains tax or miss out on potential profits. Therefore, it is important to understand the risks associated with crypto tax loss harvesting before utilizing the strategy. You also have to keep in mind that every investor has a different tax situation. So before making changes to your portfolio, make sure you consult with your tax advisor. What do you think about this technique? Let us know down in the comments section.